India Ratings has published the FY23 mid-year outlook on the banking sector. In this episode of the Expert Lounge, we understand what's happening within the banking space. Hi, I'm Siddharth Rego, and today I have with me Karan Gupta, Director at India Ratings, who's going to take us through the mid-year FY23 outlook on the banking sector. Karan, welcome to the Expert Lounge.
Hi, Siddharth. Thank you for having me here today.
Right. So, Karan, I've had a look at the report which you have recently published, and the rating outlook I saw for both private banks and public sector banks is stable, while the sector outlook is improving for the overall banking sector. That was the first key takeaway which I saw. But if I have to go into specifics, one thing that was mentioned and that came across very evidently was the fact that credit demand is strongly outpacing the deposit generation, and all this has been happening amidst deposit rates moving upwards. If you can just help me understand this theme a little bit better.
Right, Siddharth. Thank you so much for that. Siddharth, just to start with a few numbers on this. The system level credit growth currently is at about 15.5%, and while deposit growth is trending at about 9.5.
Right.
So you see the gap between the two is quite high, and this has been widening as in the last few months.
Right.
Further, what we believe will happen because of this is that there will be the competition between banks will only intensify for deposits from here on.
Okay.
This is being driven by a widening current account as
Okay.
well as outflows from the capital markets. Further, we are sitting at record cash holdings, and the increasing risk appetite of banks, which is reflected in the credit growth numbers that we see,
Right.
would only lead to higher competition for deposits within the banking system. Furthermore, the tightness in liquidity for banks is also visible in the coverage ratio, in the liquidity coverage ratio declining on a quarter over quarter basis, or even if you look at it on a year over year basis.
There's a declining trend in the interest cover.
Yes.
Okay.
And when you also look at the CD rates, which is nothing but the certificate of deposits, which they raise from the market for a period ranging from 1 day to, let's say, 1 year, even there, the rates have continuously been moving up. So that also tells you their appetite for taking on deposits is increasing as they are seeing a good offtake on the credit side.
Interesting, Karan. And you have also, in fact, made an upward revision in the FY23 credit growth to say something around 13%, if I'm not mistaken. If you can just take me through what has been the basis for arriving at this credit growth rate.
Right, Siddharth. So on the credit growth side, what we've done is that we've revised our FY23 credit growth estimate to about 13% now, which was at about 10% at the start of the year when we had put out a full year outlook.
Right.
And this is being driven by a few factors, namely to start with, the rise in working capital demand that we see from corporates, even as capex plans are getting pushed out because of the global uncertainties that we see along with rising inflation.
True.
With the adverse interest rate movement, as in it's moving higher, there is also a visible shift that we are seeing from capital markets to the banking segment, because the banking segment is not just a fair weather friend for corporates, but an all weather friend as they see it. In addition, there is credit demand from the corporate segment, which is better than expected because of certain segments such as infrastructure and chemicals driving it. Even in other segments like services, there is the whole NBFC segment, which is seeing a lot of growth coming in and contributing to the growth. And on the retail side, again, the demand that we see with the effect of COVID waning off is turning out to be better than our earlier expectations. So all of this put together is leading to an upward revision in our credit growth estimates for FY23.
Interesting. So there's growth right across the spheres, across the sectors.
Absolutely.
Right. And you've also mentioned within the report that asset quality concerns are subsiding and there are lower incremental credit costs. So, Karan, would it be safe to assume that this would kind of support the profitability of banks?
Absolutely, Siddharth. That's absolutely on point. At the very start of the year, when we had done the full year outlook, we had said that the banking sector is currently, best placed in terms of its health in the last 2 decades, and it's panning out, as we had talked about. when you look at capital levels, when you look at asset quality, you look at the other numbers, those are all there for us to see, which reflects in the health of the banking system. Specifically on the point that you raised, Siddharth, about the asset quality and the provisions.
Right.
When we're looking at the stressed asset pool and the movement in that, right?
Yeah.
We because of the COVID-related provisioning, the COVID-related framework that RBI had come out with, which was COVID 1 and COVID 2 restructuring framework, what we've seen is that the stressed assets for the system remained elevated at about 8 odd percent in FY22 at the end of FY22. And this is only going to marginally increase to about 8.25 by the end of FY23. Now, this is primarily being driven only by an increase in GNPAs. However, there is a caveat there that we need to be mindful of. These numbers that we have taken are without the assumption of write-offs.
Oh, is it? Okay.
Normally, there are write-offs of about 1 to 1.5% every year that banks do. And if we factor that in, then GNPA or stressed assets are likely to decline on a year-over-year basis, which tells you that the asset quality metric for the banking system is bound to show an improvement. So, that in a nutshell is about the asset quality.
Okay.
Now, shall I move on to credit costs?
Sure.
On the credit cost side, what we are seeing is that, credit cost for the banking system is likely to fall to a 6-year low of about 1%. Just last year, for the fiscal year that closed for FY22, this stood at about 1.4%.
Okay.
Now, in 1Q FY23, the PCR, the provision coverage ratio, which is also a very good metric, which reflects how much provisioning banks are going to require in the future, that also stood at a very healthy level of about 70% for both private as well as public sector banks. So that tells you that, the incremental provisioning requirements are not going to be that high for the banking system. There is also a lot of talk around, a transfer of assets to the National Asset Reconstruction Company Limited. But we believe that would not be very material. It wouldn't have a very material impact on the credit costs for the system,
right?
Because the valuation at which these assets would be transferred and subsequently the cash that banks would receive would not be very high.
Interesting, Karan. Very interesting. Thanks for actually putting everything into context and into perspective and summarizing it in a nutshell. And speaking about summarizing things in a nutshell, if you're the listener to this podcast, what are the key takeaways that you'd want to take away?
Right, Siddharth. So on that, I would start with our first theme, which is where we talk about both the intensity of competition amongst banks for deposits going up. And this will be in terms of both gathering deposits as well as the price that they are going to pay for deposits, which will only continue to inch up from current levels.
Right.
The second part is on the credit growth side. We are seeing incremental loan to deposit ratio touching almost 110%, and with credit growth continuing at levels which it is. For FY23, credit growth shall play out very well for the banking system.
Right.
Third, but not the last, on the asset quality side, while there will be slippages from the restructured and the ECLGS pools, which primarily will come from the retail and the MSME sectors, we still believe that asset quality numbers on an overall basis, post factoring in upgrades and recoveries and write-offs, the numbers will look better on a year-over-year basis. And as we discussed, credit costs are going to come in at a 6-year low, to be precise, at about 1%. And we will also see, more importantly, a convergence of credit costs between the private banks as well as the public sector banks, which used to have a wide disparity if we look at, the past.
Right. Thanks, Karan. Thanks for taking us through the banking sector outlook. If you're a listener to the Expert Lounge, I'd highly recommend you read the mid-year outlook on the banking sector. It's titled Focus on Growth Back, Competition for Deposits to Intensify. The link to the full report is attached along with this podcast, so do have a look at it. But in the meanwhile, that's all we have for this episode of the Expert Lounge. It's a podcast brought to you by India Ratings and Research, because for opinions on risk and credit, India comes to us.